Hello and welcome to our latest Stamford Brand SB Talks podcast. We are once again joined by our Chief Investment Officer, Ashley Owen, to discuss the quarterly review of investment portfolios and the broader market outlook. Welcome, Ashley.
Welcome, Vinny, and welcome, clients, wherever you are in the world. Good evening, good afternoon, and good night.
So, Ashley, most appropriate place to start is probably the attention last week on the April 2024 government bond and the RBA's stepping back from maintaining their 0.1% target.
Well, it's that's right. So, just to recap, October is finished. It's now, I think, the second-ish of Melbourne Cup Day in Australia, which is the only country in the world.
Where's your fascinator?
The only country in the world which actually literally stops for a horse race, but that's Australia. Portfolios did very well, did reasonably well in October. They all drifted up nicely. Global shares was up 4-5% as a whole. Australian shares were flattish. But in general, Aussie shares are heading for a better than average year this year. Global shares are heading for a better than average year this year. So portfolios have drifted up again, which is good. In the change on we've been watching the markets over particularly the last year and a half since COVID, and the recoveries have been very strong. Share prices have been very strong. Profits have been very strong. Dividends were cut, profits were cut, but they're coming back. Every time we look at profits globally and in Australia, the profit numbers exceed everyone's expectations. So we're always having to increase the expectations for profits next year. So that increase in profits, better than anybody expected here and everywhere else in the world, has underpinned the great share price rise we're still seeing today. So the only change on the horizon is as the economies recover and they're opened up and the vaccinations roll out, all of which is good. People return to the shops, people return to the races today in Victoria. All that's good, except that does mean that the world has got to return to more normal policy settings, i.e. interest rates have got to get off zero and start to reflect the real world environment, which is normally 2-3%, 4% cash rates around the world and in Australia. They're currently sitting at zero. So the only question was, who's going to blink first? We saw over the last month, 2 or 3 central banks around the world start to rate hike for the first time. You see inflation numbers pretty much everywhere, including Australia, are well above their target ranges. In Australia, 3%, US 4%, 5%, Germany, across the world.
And suddenly core inflation in Australia beginning to drift into the target band for the first time in 6 years.
Central bankers have been saying, and our central bank is no different to the rest, they've been saying, ignore inflation, we love inflation, everything we do in life, we wake up trying to dream about ways to create inflation. Madness, you and I know that, but central bankers are in a different world. They've been saying all year that inflation's transitory, it's temporary, don't get carried away. Over the past month, they've started to think, hang on a minute, this could well be a 1970s type inflationary supply problem with commodity prices and food prices, and the price of everything's going up. So you see the producer price index with the wholesale price index, which is inputs, which is food, materials, metals, building materials across the world. Those wholesale prices that are going into the factory are rising. Now you see at the other end, the CPI numbers, for example, in China are still weak. So companies around the world are so profitable, they are able to actually collect those and not pass those on to consumers. So you've got the price of the new Apple iPhones and cars. They're still basically not moved for a decade. Meanwhile, the input costs are much higher. So the metals prices, oil and gas, everything's expensive. Food's expensive, all the inputs are expensive. So that is now causing the core inflation, the trimmed mean inflation, the headline inflation numbers in every country, including Australia, get to ranges well above what everyone thought about a year ago. So as one of the RBA in Australia has promised for a year and a half to keep the cash rate at zero until 2024, and he still says with a straight face, even today, he's sitting down at the RBA meeting today, with a straight face, he will say, we will not raise rates till 2024. He's painted himself in a corner. Probably what they'll come out this afternoon and say is that we will allow some wriggle room, and it's always going to be subject to what happens in the markets. So that'll be their out clause. So they've also tried to peg, we're back to the 1950s repression, where basically central bank governments, which is central banks governments, tell their central banks to peg rates at very low rates in order to dish out government loans to borrow money to fund these deficits. So the RBA has promised to keep the 3-year Commonwealth Government bond rate at 0.1%. Now, the only way to do that, because the market knows inflation is going to take over the market.
For them to come in and buy the bonds and artificially repress the price.
If there was a free market in bonds,
the
3-year bond would be 3.5%, 3.4%, as it normally is throughout time. But the RBA has had to buy bonds in the market to finance its own government debt. You're not allowed to say that. They're not financing their own debt. They're basically buying from third parties, i.e. the banks. So they go in one door and come out the other door. So therefore, it's not financing government debt. Therefore, it's not money printing. This is the fairyland they live in. So the RBA's had to buy bonds at $5 billion a week, and now it's $4 billion a week in order to keep that rate depressed, to keep prices up and yields low at 0.1% on a 3-year bond. They basically ran out of money. The RBA posted a loss of the financial year when everyone reports a profit for the June year. RBA posted a loss of about $4 billion, including profits it makes from printing money. Like printing paper, they make money on doing that because they cost them nothing and they give it out for $20. Their losses on their bond book, their QE bond book they bought over the last year, they posted unrealized capital losses of $8-point-something billion. So they've run out of money. Yeah, the reserve fund set up for the RBA, which the capital reserve, like a bank, every bank's got a reserve against its assets, it's literally bare. So it had to stop borrowing. So it probably will have to be bailed out by taxpayers, i.e. taxpayers writing a check to fulfill its reserves before the next financial year is out. So it is starting to say we can't
go on forever.
So basically they blink. So the 3-year bond yield is supposed to be 0.1%, as it's promised to be by the artificial QE bond buying. Today it's like over 1%. So that means that it jumped up suddenly. Now, the cause of that was two things. One is inflation in New Zealand had a very unexpectedly high inflation number last week, and then Australia did the same thing. So it's easy money. If you believe the central bank, you can simply go in the market today and buy a 3-year bond and make an instant 10% profit when the bank redeems it in April or November now, 2024. Probably the bond markets have won the battle, and probably the RBA will have to say we can't really afford to keep buying bonds artificially, printing money to keep the rate at zero, because the market is saying, the weight of money is saying that
the market is very heavily pricing in now that we will see the first moves next year.
Correct. So in portfolios around the world, every diversified portfolio around the world, pension funds, super funds, they've got their risk assets, which are shares and bit of property. They've got their defensive assets, which in most cases is about 30, 40, 50% of all portfolios. And they are always stacked full of fixed rate government bonds and a bit of corporate bonds. In Australia, it's the same. What we did in portfolios during the year, we have about 3/4 of our defensive side of portfolios is not in fixed rate bonds deliberately. So we could see rates rising and inflation rising and bond yields rising, which is bad for bonds. And we put all of that into floating rate notes, high grade, investment grade floating rate notes. Floating rate notes are different because floating rate notes rise, interest rates rise when cash rates rise, whereas bonds get hammered. So last month, the Australian broad bond market lost about 4%, which is its single biggest loss since October 1987. When they had the share crash as well, same problem. So we had a bad market for Australian bonds in 1994 when bond yields rose by about 3%. We had a 4% down bond market. Now, that's bad for portfolios generally because most of their defensive side, all the defensive side in your typical diversified portfolio is stacked full of government bonds. In Australia, in our portfolios, we have about 3/4 of our defensive side out of bonds into floating rate notes, which rise. So as cash rates rise from 0 to 0.5% to 1% to 1.5%, 2% over the next 2 or 3 years, the returns on those floating rate notes are pegged to those rising rates. So those will go up. So currently
pick up the additional yield, but we won't have the negative capital implications that you'd have for a longer duration bond portfolio.
So our floating rate note portfolio, high grade floating note portfolio, which is the vast bulk of our defensive side of our portfolios in every portfolio, that's returning currently around about 2.5%, 3% above cash per year, which is low. But as the cash rate rises to say 2%, that portfolio will return about about 2 or 3% above the cash rate. So that'll return 4 or 5%, whereas at the moment it's returning 2 or 3%. That rises as inflation rises, interest rate rise over time, as they will over the medium term. The bond market will go for more losses, a bit like 94 when bond yields rose coming out of the early 90s recession. So it'll be a similar sort of thing. We had a bond scare in January, February this year when bond yields rose. This one in Australia, particularly Australia, has had the worst bond market in the last month. Bond rates around the world rose. In the US, where we have very low, we've got very low allocations to fixed rate bonds globally. Most of it is in floating rate again, so that benefits. US bonds were up a fraction at the short end, but they were down a fraction at the long end. And what that's saying is, because the US is the biggest and deepest market in the world, that's actually quite interesting to watch, because that's saying that yes, inflation will rise in the short, medium term, which we're seeing, and therefore the Fed will have to raise rates probably next year, or maybe even late this year, but certainly next year. But the long end of the bond market is saying that's probably going to dampen growth and inflation expectations in the long, 5, 10 plus years, which means you can raise rates now to kill inflation in the short, medium term, but that's probably going to be more damaging for the economy in the medium to long term. So you see the yield curve tilt from quite steep down to it'll be a lessening the steep yield curve, which means that short-term rates will rise, which is very typical coming out of every recession. Same in the GFC, 2009-10, when short rates rose, bond yields started to come down as the boom matured. The boom is now maturing, so we're seeing that shift in the shape of the yield curve. It's all fascinating, but in portfolios, most of our money is out of fixed rate bonds. We're not hurt by the bond market collapse. You'll hear in the papers, you're seeing bond routes and bond disasters. The bond market just quite exciting. Down.
Yeah, and I was going to say, obviously, there's the bond market, and we've talked about how our bond exposures are positioned to help minimize the impact of this, or actually potentially benefit from it, from the rising yields. Equity markets have, I don't want to say largely ignored it, but certainly have not been traumatized by these fluctuations in the bond market.
Well, share markets have done very well. They've doubled since the lows into 2020. It's been a game of two halves. In the sense that there was a very, very speculative behaviour running from Marchish last year through to January, February, March this year. So the first 12 months was very speculative. The SPAC boom, the crypto boom, the NFT boom, a lot of IPO, massive amount of IPOs for no reason except there's money to be thrown at them. So the speculative boom was the first 12 months, which was March 2020 to March 21, February, March. That's when Amazon and Apple and Bitcoin and cryptos, they all peaked. Coinbase was floated in April. That was the peak of that speculative bubble. At that point, bond yields rose because inflation expectation rose, which was the bond spike in early 2020. Ever since then, share prices have kept rising, but it hasn't been the speculative end. It's been, for example, Tesla jumped, which is another story in a couple of minutes, but all the speculative stocks, i.e. the non-dividend paying stocks on PE ratios of 50 plus, they peaked in early this year, in January, February, March this year. Ever since then, it's been good, solid, profit-making industrial companies, consumer staples companies, discretionary companies, people that, which is companies that make things that people buy, they make profits, they pay dividends. So the real companies that actually do things and make profits and dividends, which is not the speculative end, they've been driving the boom since early this year. So that's been going on. The global share market had another good market in October. Primarily, Japan did well because of the lower yen, but the US big tech lead the world and have done this year, and they are very large, very profitable. Now, yes, there are moves to break them up, and there are moves in California and 20 other states, and there's European moves to try and break them up and regulate them, and to try and make Facebook sell Instagram and Twitter, etc., Instagram and WhatsApp. So that'll happen to break up the monopoly of Apple with its Apple Store. Those things will take years to occur, and if companies have to spin off subsidiaries and break up, it's unknown as whether that's actually going to be good or bad, good for competition and prices, don't know. So that's years in the making. That's a long time away. Wouldn't worry about that yet. In the case of Tesla, which is the great bubble stock of our time, that also peaked early this year with that same speculative peak, except for this month. Hertz Rent-A-Car, which is, everyone knows Hertz has been bankrupt so many times. It's come out of bankruptcy again. It's got a record going back years for never paying its bills and getting into trouble. It put an order in for, I think, 100,000 Tesla cars for its fleet. Who knows whether they'll pay? They'll probably be bankrupt again. Who knows? Anyway, Tesla jumped up 40-odd% last month on that news, and it's now another trillion-dollar company. It's joined the fleet of trillion-dollar companies. Elon Musk is now worth trillions and trillions more. That was a big news story. The other news story on the fiscal side, because you've got stimulus producing money, which is going into profits and dividends. The monetary stimulus we talked about, i.e. central banks having to raise rates to take away the punch bowl, having to stop, the central banks are scaling out of their bond buying, Australia, US. The fiscal side, which is government spending, free money, JobKeeper, JobSeeker, everything.
Infrastructure spending, education, other things.
Spending, that is being scaled out as the need starts to decline in countries like Australia, because we're now opening up, etc.
Returning to some form of normality again. Yeah.
The big number there is US. US drives world growth. US drives world spending.
And we've got the Democrats clean sweep in control across the various parts of the House.
So normally when you've got these wartime budgets and wartime deficits to fund all these handouts around the world, normally the next stage would be, okay, that's a year and a half ago, countries are opening up again. The developed world is pretty safe and sound now. That we hit, I think yesterday we hit 5 million deaths from COVID, which is sad, of course, but most of that now is in the emerging markets, which are well behind the 8 ball. So the developed markets are back on track and they're opening up and they're very profitable again. In that sort of environment, you'd expect governments to say, okay, stimulus was good, the Keynesian spending was good, that's now got to be scaled back, and we now have to start paying off debts and balancing the budget in years to come. That's not happening. In the US, the only surprise really is the amount of money that is being added to the pile. So I think in January when Biden first got in, he signed off on his $2.25 trillion stimulus bill. That turned into a $3 trillion plus one. The other day, there was another bipartisan sign-off in Congress for another 1.9-ish trillion. So the only surprise there is the amount of money they're increasing, all of which is great because it all goes into company profits and dividends, which is good for us shareholders. But it means our kids and our kids' kids will be paying this for a lot longer. So that's while monetary policy is being eased back,
there's still a heavy fiscal tailwind driving
a lot of money
markets.
That's right. So that's pretty much evening itself out. So that justifies the share prices. Plus, every time you look at it, the profits go up and up and up. So they're not unrelated, of course, because government money just goes straight into company coffers and goes straight into revenues and profits and dividends. So
bottom line. So against that backdrop, so I guess we have developments there of company profits continuing to be strong, interest rates probably realistically returning to normality sooner than had previously been projected, albeit the projections of 2024 were ambitious at best anyway.
Yep.
We've just gone through our latest end of quarter, end of September, and in October, typically we review the portfolios and determine how we are positioned for the next quarter ahead. And having come into this review, we'd been neutral in our growth defensive split, i.e. between equities and sort of cash and bonds, essentially with a tilt more towards international shares. How do we see the quarter ahead?
We've recommended no changes at the asset class level. We're still neutral, as you said, growth defensive split. So we're not super bullish. We're not betting the house on shares. We're basically neutral, saying there's a good case to be overweight and underweight. So we're neutral on growth defensive split. Within that growth side, we have no commercial property because that was hit heavily. REITs were hit heavily. They've come back nicely this year, but they're still well under what shares have done. So we've been out of those for a year. And we're tilted towards global shares. Yes, they're more expensive on a whole bunch of metrics than Australia, but they're much broader, much more, much less reliant on banks and miners, which Australia is, and so much less reliant on commodity prices remaining favourable. So we've been tilted towards US global shares, which is 80%, 60% US. That has done quite well because US and global shares have beat Australia over the last year and last year as well. We're making some changes. We'll get back to a second on the ESG and fossil fuel stance we're taking in portfolios. We'll talk about that in a few minutes. On the defensive side, just recapping, we've been 70+% of our defensive side is in floating rate notes, which pay 2-3% above cash, and that will rise.
I was going to say there's a big positive in that from the rising interest rate environment, where the artificially low yields that you've been getting from those types of assets will be improving over the next few years, back not quite back to what they were 10 years ago, but at least to a commercial return on the debt.
Yep. So cash rates won't be zero in 2 years; they'll be 2 or 3%. So on the defensive side, no change at all. We made some changes progressively during the last 12 months on getting rid of the fixed rate bonds, and that's worked well because now we've got this inflation environment which is now starting to be baked in. So cash rates will rise probably more quickly than everyone realised a year ago. So we're positioned for that. So basically no change at the macro level, but we're making a couple of changes on the fund side, particularly in the global share side.
So you alluded to it before, and let's talk to it now. There's obviously a lot of attention globally at the minute with the COP26 that's going on, and Australia's commitment to net zero emissions by 2050. And it's worth saying that we've been looking at this area for some time, and our focus is probably around what are the long-term major themes that are going to be happening, affecting the world, affecting economies, affecting companies, and how that should be layered over how we implement portfolios and our portfolio methodology. Perhaps you could start to unpack that a little bit for the listeners.
Right. So
just a very succinct, simple area, right?
It's a simple concept. It just happens to be now when everyone's in COP26 and all the promises are going on. So the timing is just a pure luck. We started doing a lot of work on portfolios a couple of years ago on how to position portfolios for the medium and long term. Now, these are long-term portfolios. These aren't trading portfolios. You're not going to double your money in a year. These are portfolios for people's wealth and their families' wealth for 20, 30, 40 years. So we're thinking long-term. I once spent about a week reading the Intergovernmental Report that came out about 5 years ago, thousands of pages, and I had a go at reading the 180-page one the other day. There's a lot of smoke and mirrors. There's a lot of numbers, and there's a lot of you need 3 degrees in from Hogwarts to understand how those are written. But basically, we're not here in a position here to say whether temperatures will rise by 1 degree or 3 degrees or 5 degrees or -2 degrees. We're not here in a position to say that we think humans are doing this or not, or coal is good or bad. Everyone has a view on that, and everyone has a view about how to respond to that. We, in a portfolio, we have to basically look at the financial outcomes, and we have to look at risks. We look at risks from inflation, we look at wars, we look at revolution, we look at deflation, we look at economic growth, we look at so we look at all the risks in a portfolio. One of the risks in portfolios for investors is going to be climate change, and what that means when you unpack it was so what? It could well be at worst case, and this is the worst case scenario, and some people believe this. Worst case scenario is temperatures will rise by X degrees in X years, and that will destroy all life on the planet. It'll destroy food, it'll destroy crops, it'll make life unbearable certainly for islands who are, I saw a show on islands at less than a metre above water. Those will be gone. So for investors, we need to think about the impact of those sorts of activities on investment returns, which is it's very hard to model, but it's certainly there are paths through the thinking on this. So, for example, fossil fuels currently power the world, have done for a century in various forms: transport, electricity, etc. There is no doubt a move away from fossil fuels to more sustainable sources of energy. We're talking basically coal, oil, and gas, the big ones. Now, some companies, and there are companies that have done very well over many, many years. ExxonMobil, for example, was the biggest company in the world for many, many years, biggest American company. It is now out of the top 10, and it's getting smaller, even though it's had a great year. These companies will have to deal with a lot of issues, and some companies, for example, they've got to invest heavily in renewable sources. Some are doing better than others. Some are ignoring it. Some are ditching old sources and going to new sources totally. So some companies will completely die. Like in every industry that goes through changes, competitors die.
Yeah, so it's a fundamental structural change for that whole sector coming up.
In its place, there'll be new companies we don't even know about today that'll come out. Tesla didn't exist 10 years ago. Google, Facebook didn't exist. So there'll be new companies that don't exist today that will take over and lead the world in the decades to come. Our fear is that a lot of the old companies, and not just the oil and gas, fossil fuel, coal producers, but a lot of spin-off industries, a lot of related industries, a lot of supplier industries with those, will be hit with a lot of costs, remediation costs, cleanup costs, taking down wasted assets, stranded assets. Look at BHP's got all these BHP operations in the Bass Strait. They're going to have to be taken down. They've flicked past those to Woodside to clean up. So various companies are going to be in a lot of trouble. You look at all the oil and gas spills over the last 10, 20, 30 years, the massive Exxon Valdez type spills, the Deepwater Horizon spills, those cost tens of billions of dollars to clean up. So some of those companies will be crippled and die, disappear, just like in every industry, companies die. Other companies will come into their place. So we can see that as an industry, the fossil fuel industry is likely to underperform in financial terms for those reasons alone. The sheer cost of transition, the sheer cost of change, the sheer cost of undoing the messes they've created, filling the holes, taking down the oil rigs. It's going to be horrendously expensive, far more so because there's more regulation around how you do that. You can't just blow something up. You've got to take it apart piece by piece and redeploy it. So very expensive. So in portfolios, we have a lot of assets in portfolios. We have shares, we have property, we have cash, we have bonds, we have commodities sometimes. Every one of those is affected differently by climate change as a risk factor. In the case of shares, which are more easy to understand because you're dealing with companies that do things, that use power, that produce products, we have they come in two flavors in our portfolio. One flavor is active funds. We have 3, 4, 5 active managed funds.
So you've got a portfolio manager there making a decision of what you choose to invest or not invest in. So there's sort of a human overlay with support teams and other things. And
then you have passive funds, which are index funds, low-cost index funds, Vanguard funds, iShares funds, etc., VanEck funds. Now, we're treating those differently because the decision-making processes are different. In the active funds, every fund manager now has to report on their carbon intensity, their carbon emissions of the companies in their portfolio, and they're very careful about how they manage those and manage those risks, including the risks of remediation, the risks of transfer, of transitioning, etc. So we've got a process to get inside the active fund managers to understand how they manage risks. So we're doing that anyway. Where it's different altogether is the passive funds, which are the Vanguard funds. And we have these in portfolios primarily as tactical holdings, low-cost holdings in order to do our tactical changes. Some of those are core holdings and for low-cost exposure. We have, starting with global shares, this cycle, we are shifting from, now the problem with the passive fund is when they go for say global shares or US shares or UK shares, their job is to buy everything willy-nilly regardless.
You buy the index, therefore whether you like it or not, if it's in the index, you get it in the.
So the index has 4,000 companies, you get a piece of all 4,000 companies.
So as you would have described, 10, 15 years ago, the major energy companies would have made up the large chunk of the top 10. And if you had an index holding, you would have owned them all.
That's right. So in our current funds and index funds and portfolios, we are shifting from, for the core fund in our international share portfolio, we are in this cycle, we're shifting from a fund that buys everything, good or bad, to a fund that is filtered. It's got some filters on it, I'll describe it in a second, but it also, the major one being, it eliminates almost all of the fossil fuel exposure in portfolios. So, for example, fossil fuel producers currently make up about 3% of the population of the global market value of companies worldwide. The ExxonMobil, Shell, BP, etc., Chevron, also BHP, Rio, they're big coal producers, Woodside, Santos, etc. They only make up 3% of the current value of portfolios, which is a lot less than it was 20, 30, 40 years ago. but it has the capacity to make enormous losses. So if you look at the losses in 2015-16, we had an earnings recession globally. Every country in the world had an earnings recession, not an economic recession, an earnings recession. Corporate profits went down. That was purely to do with oil and gas and steel losses in the energy industry. So even though it's only 3% of the market, it has the potential to damage portfolios irreparably. So we have taken out those oil and gas and coal stocks in our index fund we've selected for the global share portfolio. That'll reduce the carbon emissions, the CO2. Now, the good thing about now, there's lots of measurement systems and reporting systems, and they all have to measure and report on these so we can tell what they do. So currently, the typical global share portfolio emits around about per $1 million of invest. If I invest $1 million in this fund, I am responsible for about 230 tons of carbon emissions per year. That's a lot. 230 tons is a lot of in the atmosphere. So as an investor with $1 million, $1 million has bought me a list of companies which emits 230 tons. And about 1,900 tons of reserve emissions, which is the reserves under the platforms in the ground or under the coal mines, which they will at some time in the future exploit. By shifting to this low carbon emission, fossil free portfolio, it basically reduces the carbon emissions today by about 20% across the board. And it reduces the carbon reserve emissions, which is the yet to be polluted emissions, by about 99%. So it goes from about 1,900 tons of carbon emissions per year to around about 6, which is just a residual amount. So by doing that in one fell swoop, we take away the fossil fuel producers from portfolios, and we reduce by about a quarter the carbon footprint of the portfolios, which is pretty good. Yeah. The downside, of course, is if you go through the list of stocks, all of a sudden you have no ExxonMobil, you have no Chevron, you have no Aramco Saudi, you have no. Now, the financial impacts are paramount. Oil and gas stocks and coal producers, energy stocks in general, by and large have underperformed the global market, but it depends on the period. If you pick a period where oil prices have risen, like this year, oil and gas stocks, coal stocks do very well. So if you look around the world this year, you've got all the oil and gas stocks up 30 or 40%, pretty much across the board, including Australia up 10, 20, 30% as well. When oil prices are flat or negative, which is our long-term outlook for oil and gas as it goes out of favor and is replaced by better methods, then they will return to a situation where the old energy companies, if they don't transition well, and if they die or fall by the wayside, then they will underperform the index, which is done for decades. So it's a question of timing. Given, and it's purely luck that we're doing it now because we started planning this 2 years ago. But
well, guess what you're saying there is the timing to implement a filter such as this on portfolios is somewhat fortuitous because they've had a strong year in terms of recovery in their prices.
That's right.
Yeah.
Yeah, so we didn't pick the timing, and nor should you try. But this is a long-term trend, a long-term issue we're dealing with here. It just happened to be not a bad time to get out of oil and gas because it happens to be a year they've had, which is good. I mean, oil prices have doubled this year. They went from negative last year or zero last year. They're now back to $80. Most of this gets back to the inflation debate with central banks. Most of the energy crisis we're seeing, particularly in the Northern Hemisphere with blackouts and factory shutdowns and supply chain problems, a lot of that is to do with, in fact, most of it's to do with supply constrictions, partly OPEC, but most of it's to do with things like COVID lockdowns affecting ports and affecting operations. So the oil price being $80 plus today compared to half this time last year and negative a year and a half ago, a lot of that will start to ease as we get into next year. So we're not seeing another 5 years of oil price rises. Probably it's actually not a bad time to make that call. It's pure luck as it turns out, but it's not a bad time to do it.
So let's just, there's many elements to that. So if we can, I'm just going to reiterate some of it and just for the listeners, at the minute, we are looking, this is impacting the exposures we have in the index or the passive parts, passive sleeves to our portfolios. So where we'd previously used broad index managers such as Vanguard, we're going to select variants of that have a filter on it that is going to basically screen out those exposures to those fossil fuel type providers. And we are doing that essentially because we feel medium to longer term investment wise, that will create a better, superior investment performance. And also potentially, obviously, you get the additional benefit of it's going to have a lower carbon footprint. At this point, we are starting to do that review purely on the international equities. And that's one that we are going to implement in portfolios in the next week to 10 days. And we will then revisit that across Australian equities and other sectors over time in the near term future as we can add, as we build out, I guess, this methodology across the entire portfolio.
Yeah, good summary. Yep. Perfect.
Any other items, any other key things that are on your radar that you that are keeping you up at night as we prepare head towards the end of the year? Apart from the Melbourne Cup and picking your winner.
No, but there always are. My goal in life is to go to a Melbourne Cup. I've been to many Melbourne Cups when I lived in Melbourne in the 80s and then in the 90s. It's a good day out, but I would like to see a Melbourne Cup where a horse doesn't come away not alive. I'd like to see them all run and be happy and successful horses. That's my only interest in horse racing currently. But I hope you pick a winner.
Another debate for another day. Well, I think that's a huge amount of information and appreciate you running us through that, Ashley. We'll also have our quarterly report going out in the next week that will delve in much more detail around the methodology in how we're reconstructing portfolios and the approach that we're taking. But we very much encourage our listeners, our clients to reach out to their advisors and ask more questions, understand it more, and we'll certainly talk more to this area over the months and years ahead. As we said, we take the custody of our clients and their families' monies very seriously, and this is about us responsibly and prudently positioning us for the best way to, I guess, protect the capital and grow it over the many years ahead. Ashley, good luck, and thank you very much.
Fantastic. See you next time. Bye-bye.
Thank you. Bye.